I'm just talking with the tech guy. It's not live.
Oh my God, are you serious?
Just be careful because we are still live. Okay. All right. Looks like we are back to being live. All right. Welcome everybody to the live stream. Welcome. I think we're finished with the technical issues there. So it's great to be live here today. We've got a great session. This is a Pepperstone Learn It Live series event. Of course, today we're talking about advanced scalping techniques as we navigate uncertain times. And Tyrone, this is one of our favorite topics, isn't it? We'll go live stream over here and we're ready to rock. I love scalping. I love breaking down markets and trying to gain edge. And of course, that's something that we'll be doing today is teaching you some advanced techniques that we use on the charts.
I'm so pleased that I didn't swear, because we were live for that part that we didn't think we were live. So we are very, very pleased to be with you and absolutely live. So that is great. It would have been very, very frustrating if we couldn't bring you tonight's webinar, because we've been excited about it. But yes, we are good to go. Can't wait. Yeah, really, really good topic. I love scalping. And it is all about the key levels. And there's, in uncertain times, look, it makes sense, right, that you want to be in and out of the market as fast as you can, because realistically, the way to trade uncertain times is to be very, very agile and keep your entries and exits relatively short. So looking forward to getting into it.
All right, well, we'll just play a quick disclaimer and then we'll get stuck right into it. See you soon. All right, well, we just want to remind everybody that we're going to be covering quite a few topics today. We'll be looking at how to break down a chart to set up for scalping. We'll be looking at live charts for technical analysis, and of course, key indicators and entry points, along with live Q&A. If you do have questions, there's helpful members of the team in the chat, but also we're reading the chat as well. So if you have any questions, feel free to ask them throughout and we'll answer them as best we can if it's relevant to the time, or of course we'll answer at the end. So without further ado, let's get into scalping in terms of breaking down some of the key methods. And I think, one of my, I guess, kind of the people that I always look towards, and I think he was really a great reader of what he called the composite man, that is the market being kind of an entity upon itself, was Richard Wyckoff. And of course, he said successful tape reading is the study of force. It requires the ability to judge which side has the greatest pulling power, and one must have the courage to go with that side. Now, sometimes the worst feeling trades, that is the trade that you take where it's statistically likely to be successful because it's replicable, which is a strategy or a concept we'll talk about a lot today, replication and being able to constantly follow a very similar technique. Sometimes it feels bad, but they are often the ones that work very well because, of course, the market preys on our kind of emotions of fear and greed, doesn't it, Tyrone?
Yeah, most definitely does. And a lot of people think, how can the market possibly do that? But it's really the force of numbers. And probably no better indicator of that is actually sentiment trader that I'm not sure if we're going to touch on today, but they're the sorts of things that the market does prey on. And it's very easy to fall into that trap. But look, it's not the sentiment doesn't work, but what you want to do, you want to certainly have your own ideas as to why you're doing it. And if the crowd is with you, that's great. And if it's not, let them run. So yeah, we're definitely going to jump into that a bit. But yeah, it's not that. Don't confuse the market trading and playing on your psyche as opposed to brokers. People get confused and think the brokers are trading against them. It's actually not the case. The market is its own beast, and a lot of the time people fall into the trap of actually following the herd, and sometimes on false pretenses. So it's very, very important that you do maintain your own ideas, and we're going to show you some of those today.
So here's a bit of a breakdown. We had just some of the most popular pairs, but here's a breakdown of some of the best times to trade. Of course, the opens, the London Open or the European Open, the Asian Open, and the US Session Open. The highest form of liquidity is usually the overlap. That is the point where you kind of go into London lunch or European lunch and you open the US stock market. That's the highest volume generally of the day, outside of really any other kind of key economic news. And why this becomes important is because the market generally does certain things around these opens. A lot of people have open-based strategies. That is, they look for, let's say, the European Open each day, they create a range in the market, and they break down the market in a certain structure, looking for traps or tricks that they could get into, breakouts, or of course the traps, stop losses, liquidity grabs, all sorts of things can occur over these periods. So when we talk about scalping, you really need to think about price action and also how are you going to break down the market to actually activate. And today we'll be discussing one of our favorite things, like basically a schematic that allows you to kind of approach markets a little bit differently. Now, to say markets are easy to trade is not true. They are quite difficult, but keeping it simple can be one of the best methods to really understanding market conditions. So most of you will understand this is a downward market. It's making lower troughs and lower peaks and lower troughs and lower peaks, or lower highs and lower lows. It then goes on to change that trend, and it breaks past the last series of the lower high over here. So that then gets taken out. This is what we call a first time frame change of trend. And when this occurs, the market often will go in a direction, but then it will often pull back. Now, a lot of people choose to trade the breakout. And the problem with the breakout strategy is while breakouts are really solid kind of entry points, at the same time is they tend to pull back and then scare you. And we've all been in this situation. And in the chat, if anyone has ever been in this situation where they've traded kind of a breakout like this and then the market's pulled back against them, you sometimes get a little bit scared, and often you'll pull your position out and you'll be very, very scared in terms of as it comes back down, and then it will go off to redirect in the direction that you originally had planned. Nothing more frustrating, Ty, than when that occurs. But the good news is it can be used in scalping techniques when you identify key levels. And what you should be looking for is you need to have a few key kind of psychological traits. Number one, you need to have the patience to wait for the market to come to your level. Any scalper must have patience. If you don't have patience, you will generally fall apart and make really bad decisions. The second thing is you really need an abundance mindset. That is, there's always another opportunity and you're willing to wait for that opportunity. Abundance mindset is super important. There's always another trade. Remember, a lot of investors, one of the reasons I think so many of them fail, Ty, is because they fall in love with a company or a stock.
Yeah.
Or even
100%.
they fall in love with the price on the index. And it goes to that price or it doesn't go to that price. They miss it. And then they fall into the FOMO and the greed. And we've all been there, haven't we?
Yep, we have. And it's easy. Look, it is easy, especially if there's sentimental value to a particular stock. Sometimes I think that's some of the biggest traps sometimes. Like people actually do fall in love, like you say, and they basically don't see the forest for the trees, if you like, in terms of levels and what is actually a good buy and what not. So really, you end up holding on longer than you should. Sometimes you buy too early. You don't recognize the real patterns. And I always say, the best way to trade is to have an unbiased, view on the instrument that you're trading. We often say, especially during our webinars, look, we have favorite instruments that we like to trade, but it's a favorite instrument that we like to trade both ways. And I think that's the important part, that we're, if we love trading, say for instance, we love trading the Euro USD and the dollar index, basic inverse trade. It's not that we're in love with a direction. I couldn't care less whether I was actually shorting the Euro USD or longing it, to be honest.
Mm-hmm.
But we love it because it can be very, very technical. So we're in love with the trade style, if you like, because it's a very technically sound, good level instrument, but we're not in love with the actual instrument itself. And that's the important part. You need to make that delineation where you're quite happy to short it or long it, or just as importantly, even exit. You have to short it, but you can exit it when it's required. Okay, you don't want to hold it for sentimental reasons. That's a real no-no when it comes to actual trading. If you're investing, maybe you can get away with it, but for trading, it will chop you apart.
So with these particular locations, we're going to show some live charts though. So I'll actually go into some charts and I'll show you some of the action that's been had over the last week, and we'll talk about the current markets. But this is actually paramount. Being patient enough to wait for it to come back to you. Again, here, higher highs, higher lows, and then it breaks past that lower low, effectively changing trend on what we call the first time frame. Now, different people call this different things, but in essence, it's the first kind of change of trend. And it's very important that you actually, at that point, wait for the market to pull back. If you make that one little change in your scalping techniques, you'd be surprised how often the market actually comes back when correctly identified. You would really be surprised. And I'm always encouraging people, if you ever put it in the comments down below, or if you've ever tried these types of strategies, that you focus on on whether it does pull back, look through history. And if it does, you'll be like, oh, okay. And it'll start to make sense. And it will cause you to get that patience, that abundance style mindset.
Yeah.
Hopefully that makes a difference in someone that's listening right now.
Yeah. The pullback trade is often the better trade. Look, make no mistake. And look, there are going to be times when it breaks out and it doesn't come back. And you're going to say, bloody Tom said we're going to wait for the comeback. Remember, the importance is that the majority of trades are what you want. Some of them are just going to get away from you and they're not going to come back. But realistically, if you have the patience to wait, you're going to find, and you'd be quite surprised how often they do come back and test it. And it is the better quality trade.
So this is just another kind of example of the scenario. Again, we want to see it break past that last movement, okay? That last peak or that last trough. And that's the key here. But you also know that there are other kind of schematics or other concepts out there. Of course, Wyckoff had his very own, which was based on accumulation and distribution. And on a higher time frame, this is something that can really play out. And we've got some examples of this in the current market right now. But what I want to do, Ty, is before we go any further, I want to actually just jump into the charts and we'll jump on over to gold. Okay, and we'll have a look at gold most recently and we'll load that up. And we'll check it out. So we'll just quickly go here. And by the way, if you're using Pepperstone with TradingView, you can just select here and you'll be able to see all of the gold codes that Pepperstone offers. So here we have gold versus the US dollar. And we can go over and we can find out, the most recent prices. Now, what's important about this is, let's say we were looking at this as a blank canvas. Let's just say we didn't see what had currently happened. When you're looking, even as a scalper, you need to be aware of what's happening on the higher time frames. If I came to a weekly chart, I'm pretty aware that we have kind of like a resistance point up here and multiple supports that have been formed down here. So therefore, they're two critical zones. You also know that we previously had a level of support here that could have become and did become a level of resistance. Now, of course, there's way more than just that. But when a market comes up to these ranges, how are you going to enter a position? Are you going to be someone that just says, oh, I'm going to sell it? Or are you going to take the more advanced technique? And remember, listen to what we just said before about those ideas of higher peaks and higher troughs. Here we have higher peaks, higher troughs, higher peaks, change of trend on the first time frame. Now, look what happens after that. It pulls back and then sells off. Now, if you had been able to identify from a multi-time frame standpoint the higher time frame and then bring it on in and been patient enough to allow the market to create what we call the structure, or Wyckoff called, in his case, schematics, then we would be able to effectively really see how the market was going to set up and focus in on these levels being our scalping kind of concepts. The good thing about this is you're giving yourself a higher probability of success because, of course, you're being patient, Ty. And you'll notice up here we say patience, react, don't predict. What we're doing is we're reacting to the market telling us it's found that level as a key point of resistance or a key point of support. And that's an advanced technique in itself. Now, can you add extra things on top of this? Yes. Of course, you could add Bollinger on top of this if you wanted to, which you can go in there and add a Bollinger Band strategy. Put Bollingers on, look for when Bollingers are coming from the outside of the extreme level to the inside, potentially look at shorts. You could add Fibonacci's. You can add a whole bunch of different strategies onto this. But in essence, the price action starts the process of showing you that it's a key level that you should therefore be looking at either the short or the long, depending on the higher time frame. Multi-time frame analysis, Ty, we talk about it for, I would think, like 6 years now. So long.
Absolutely. Yeah. And look, it's everything. People underestimate it. It's so important because it really gives you the overall picture. It's really about taking the big lens to what the market's actually doing. Very, very important that you do. And I think Mohan asked the question on what time frame chart that is. That's the 15-minute chart that we've got. But we started out with the weekly. It doesn't matter what it is, actually. Like, I think Tom's right. Whatever it is, it doesn't actually matter because price action is price action, right? So, and T-Paul also asked, are we able to show some examples on a real chart? I know we're doing that now. But T-Paul, if you're having issues with the the lines that we drew earlier are the basis of all trends. So even though it wasn't on a live chart, you saw the series of peaks and troughs. In our course, we talk about how to apply that to a real chart and actually how you can actually maximize the higher peaks and higher troughs and lower peaks and lower troughs on a chart. So if you haven't already, I'd encourage you to check out the first module of the course, because that really explains how you can actually translate what looks like a very easy way to predict which way the trend is going straight into the market. And then there's no ambiguity as to which way it actually is going.
So here's an example of the euro. So people are saying, well, show me live chart, show me action. I understand, obviously, of course, this is for educational purposes. But like in this case, what we've done is we've overlaid this larger move down, which was incredibly aggressive, a very fast move. Now, when you have a fast market, you have a lot of FOMO that you want to go short. And of course, someone may have shorted here and possibly they had a strategy around it. In essence, and this is why I want to put this level up, Tyrone. In essence, I've kind of grown above this kind of trade. Now, it's great if you've got a reasoning to sell up here. And don't get me wrong, getting that entrance is awesome. But this type of aggressive move, you've got to ask yourself always, is it replicable? So what I'm talking about there, and what Tyrone and I talk about all the time, is if I enter a short in here, where is my stop loss going to be? Where is my take profit going to be? And more importantly, is the risk reward worth it? So when you're considering then the pullback that have occurred since that point, we've gone to two key Fibonacci's. We've gone to the golden ratio, a 61.8 fib. Most people know of this fib. And we've also gone to a 78.6 fib, which is kind of often considered the last level of, let's call it support or resistance before the market kind of turns over. And why this is important to really look at here is because of the nature of how the markets have set up. So if we were looking at, let's say, a 78.6 and you said, look, you know what? I'm interested in this zone. This was literally only a day ago. It's a pullback, 61.8, 78.6. Both of these zones you're, let's say, very interested in. You could then drill it down into a 3-minute chart. And what you'll notice is as you come across to this chart, you're getting kind of like a series of changes of trend. You've got basically a market that goes up, a market that goes down. It forms like kind of like a tight, consistent level. A market makes a new peak. Now, where does that peak get broken? Or where does it break back through? Here. It takes out this level. Remember that sequence that we had before. This is a sequence that really changes the game in the way that you approach it. What do you expect after that level? For the market to pull back. Now, a lot of people, what are you going to do? They're going to try selling it here. Instantly, they're down. The problem is that they haven't been patient enough to allow the market to come back to the key zones. Whether that be here with the stop loss above here, or here with the stop loss above here, or here, doesn't matter. Obviously risk rewards. You can still see that this was the shifting point for this market that then allowed it to go down to that next key support. And there's really good potential trades in this type of stuff. So this is a kind of like a sequence or a more advanced technique. Again, you will eventually need to understand supply demand, support resistance, and many other metrics to get the highest profitability, highest probability kind of zones. But it is the essence and the beginning of understanding how price action works and how you usually get probably a little bit worse entry than other people. And Ty, I think it's a bit of a game changer for many out there that just always look at it and they'll say, okay, look, I've got a double top here. Maybe you do. But the problem is you're breaking into this zone and then it's most likely because it's broken that area, it has to come back for liquidity. And that's what happens here, isn't it?
Yeah, it is. And look, when you're going, I know you're saying, a lot of people might be saying, wow, we've gone to a 3-minute chart. Like, how could you possibly trade that? But don't forget, we've done the analysis on the bigger one. Okay. This is actually just to jump in and actually see how you would actually play the entry and the exit zones. We're not starting out on a 3-minute chart, right? Like, we're not suggesting in any way, shape, or form just open up a 3-minute chart and start trading it. You'll notice that we actually started on a lot bigger time frames, worked right down. And the smaller time frames are the ones that are going to get you in basically at the most efficient levels. They're the ones that are going to get you in and in a timely sort of space. Look, make no mistake, like Thomas said on the onset, scalping is not the easy way to trade. Scalping is actually the most time intensive and the most skill needed version of actual trading, believe it or not. But it can also be amongst the most rewarding when you get it right too, because they sometimes can have very, very tight stop losses for very big reward trades that can happen very, very quickly, can't they, Tom? They can happen very quickly.
Well, I mean, in this circumstance, let's just say you had got in this entry, let's just say you had decided this was the key level based on, I don't know, some previous resistance over here. And you'd said, okay, my stop loss is above here or above here. All right, let's put in an example. Let's say you did that. You shorted, let's say, not even the perfect price there. You put a stop loss here, giving it a little bit more. Let's give it some more. What would be your target? Well, there's two target points. There's a potential for targeting here, or there's a potential for targeting the lows, which is the most likely area based on price. And I'll explain why that is. Look at this. One touch.
That's quite timely for the question, actually. Yeah, he meant to actually ask that.
4.
Absolutely. Yep. That's exactly right. That answers your question straight up. He meant. He was actually answering it as you were typing it. Exactly right. You're aiming for, your targets are the very, very important support zones. When you understand where support zones are and resistance zones for long positions, that's where your targets are. So, and realistically, when your stop loss, I mean, that's got to be at what, 5-1? I would have thought
about 4-1, that one. Yeah.
4-1, 5-1. That's a really, really good scalp, right? Like, when you're scalping opportunities of 4-1, 5-1, you are really playing the game very, very nicely. And that was not a hard
even if you
trade.
went conservative, it's 2. So no, it's not difficult. But the thing is, to guess that this is the level straight away, to guess that this is the zone up here is not enough. Like, you could have said, well, Tom, I could have shorted the 78.6. It's as easy as that. I just popped that on the chart. But the problem is, does it always stop there? You need to see the market structure up. And that's what you've been patient enough to do there.
Yeah. No one wants to be holding the bag when it reaches 100.
Yeah. So Herman says here, so basically you were getting RR, which is obviously risk reward ratio, from the lower time frame, better RR. Yeah. Well, you're using a higher time frame opportunity, and then you're saying, okay, I believe this is a key zone. Of course, you want to be able to bring as many reasons together. And in general, we like to have 3 to 5 separate reasons to be in a trade. And of course, we can't discuss all of them today. We just don't have the time. But the point is that once you find that zone, and once you find an area that you believe is critical on a higher time frame, whether it be a daily, whether it be a weekly, whether it be a 4-hour, a 2-hour, a 1 hour, you can then simplify that down to the smaller time frames and then create your alerts and your signals and your kind of concept of switch of trend. So it's very important that you break down markets in such a way, because if you do, then you put yourself at the best possibilities to potentially have that success in trading. What most people do is they instead load it up. And hey, we were there. I don't mind if you're on a 30-second chart or 15-second chart, because if I could go back here and let's load a 30-second chart on it, close enough to current price that you'll know, it still looks the same. Still the same structure. You're coming up, you're structuring up, you make a new peak, you break it here. That's the ones we're talking about. Obviously, the profit target would be down there. It's a 30-second chart. Doesn't make any difference.
A really good example. Exactly. A really good example of how it doesn't care about your time frame. Exactly right. It's all about the market structure. And Romeo asks, isn't that swing trade not a scalp? No, not at all. Romeo, you would have found that trade would have worked out probably in a couple of hours at most, I would have thought. I guess this is a 30-second chart. So if you wanted to, you say, okay, it's not a scalp. Scalping is a concept that, can be, it's really tough. I mean, a technical scalp, if you wanted to go to the letter of the word, is to be in a position for potentially 30 seconds to 1 minute. Yeah. Maybe 3 minutes to 5 minutes. That's it. Technically, that's exactly that's what a scalp is. Yeah. And really, I mean, adding a title to how you're trading is really open to interpretation as to what you think a scalp is. Me personally, I think a scalp is anywhere between 15 and 20 pips. The irony is that a swing trade is a scalp on a 30-second chart if you're doing the same setup. You're actually setting up the same way. You're still trading in a similar way, higher high, higher low breaks, support, resistance. It doesn't actually change, but swing trade, a lot of people associate swing trades with bigger type of trades that might be anywhere between 50 to 100 pips and maybe in for 2 or 3 days rather than 10 minutes or 15 minutes. But realistically, the title of what you give how you're trading is irrelevant. It's more about how you're getting in and how you're getting out and how long you're actually in it for.
So that's about 2 to 3 hours in this case. And I would say that if you do use higher timeframes into lower ones, that it can be explosive. It could be all over in 20 minutes. It can be all over in 15 minutes. Again, you don't really know exactly the time. In this case, let's call it 3 hours. And 3 hours would therefore maybe come to the category of what you would call a day trade. So scalping and day trading and swing trading and all these types of concepts, a real swing trade is usually held for days and days and days. That's the essence of swing trading. Of course, swings can be days into weeks, into potentially even a month. Day trading is generally in and out in the day, and scalping is in and out within less than an hour, or usually it's 5 minutes to 10 minutes. This, you don't exactly know how long it's going to take. I mean, you could get into this entrance and you could say, okay, I want to get out here. Well, then it took less than 1 hour and you're still getting good risk reward. I think that getting caught up in the wording is not really the big key thing. It's if you're activating on a 30-second time frame or a 3-minute or a 2-minute chart, I mean, realistically, you are scalping.
Yes.
So profit's a profit. Yeah.
And look,
that's all you want.
Ironically, we've set up trades that we would consider a long-term investment on the exact same setup, except we're looking at weekly and monthly charts. Same thing, same price action, same price action and action required to actually get into the trade, except we're looking at a time frame that's going to last months, not hours. Okay. And that's not a swing trade, it's a long-term trade. So don't get too caught up on the names, get caught up on the technique. That's what you really need to focus on.
I wouldn't mind asking the community here. I mean, we've got 135 people watching. By the way, guys, if you do enjoy Pepperstone's webinar content like this, make sure you give it a thumbs up. But have you guys been, when you're trading, when you're, doing all of these things, do you like to hold positions, let's say over a 24-hour period? Yes or no, basically. Do you prefer to hold them just for that day trade? I'd be interested to know what people here say. Would you prefer to hold it just for a few hours or potentially a few days? I'm just interested. I mean, obviously today's scalping, but I would like to see the answer. Paul says here, interesting concept as I look at the 20 minutes to an hour as I day trade. Yeah, of course. Like you can focus in on those charts and I've got no problem with that. But I think an advanced technique is to still understand the beast, understand the higher timeframes and do the work on the charts. Like right now, if you were not aware, this market, you weren't on a 1 hour chart and only a 5-minute chart, you may not be aware how big a level this is. We just made a new low. Now, I would probably expect it to pull back throughout the day at some point and then potentially short off, but we just made a new low. This is pretty pivotal zone. So, I mean, it's important to know that. If you don't have that information, it's like having part of the puzzle, isn't it, Ty?
Yeah, 100%. Yeah, 100%. And Paul also asks, he asked about, do we consider entering on a 5-minute chart as a scalp? I tell you what, Paul, God honest truth, we've been trading professionally now for, coming on 12 years. And probably I would say at least the last 8 of every trade that I've ever put on, I have not actually considered whether it's actually a swing trade, scalping trade, or a long-term trade. I do not label them at all. I know people like to label them. I know this is called a scalping webinar, but really it's more about actually how you're getting in and how you're getting out, because we're talking about smaller timeframes and we're focusing on the smaller ones. I honestly, and I know Tom is the same, he doesn't sit there and say, you know what, I think this is going to be a scalp, not a swing, or this is going to be a swing trade, not a scalping trade. We look for the price, we look for the setup, and whatever it is, because it doesn't really matter in the end. And just sort of leading on to that, we had another question on, which time frame would we prefer if you work full time, which is the best trading? That comes from He-Man. That really comes down to not so much what time frame you're going to go on, but actually what time of day you can actually trade. Really, like Tom showed up the different times of the day that scalping is most prevalent. Now, if you work full time but you're able to trade that London US crossover, that's probably going to be a scalping sort of environment, because you're going to be able to get in and out very quickly because there is a lot of volatility. So, that's the sort of, you're going to go down to the smaller time frames because you've got a very small window. Okay. So, but if you're able to trade those few hours, that's the time frame you're going to go. You're going to go 5-minute, you're going to go 3-minute, maybe 15-minute. But, if you haven't got that opportunity, and say you work night shift and you're trading the Asian session instead, you're not going to probably get the volatility that's going to get you in and out as fast as you need to. So you're going to look at bigger time frames, which are going to play out probably while you're at work sometimes, or not in the time frame that you're actually sitting in front of the charts.
Yeah, so there's a lot of different questions coming here. Bob Atkins says 1 minute chart, profit target 3 pips. So obviously incredible scalpy kind of side. You do need to be, of course, very careful and mindful of slippage, news, and all sorts of things. That is certainly look. There's many different ways. The only problem with something like that is always going to be, of course, news events, slippage, those types of things. So, one thing is, it's like, what type of trader do you want to be? You can call yourself a scalper, be on these timeframes, and focus in on the opens. And why I wanted to mention the opens before and even mention these times and understanding the higher timeframes is because markets will come back to grab liquidity. That is, they'll set themselves up in a position where the market will then spike a zone and move away from that. So, for an example, let's just say, and you can see based on volume here, that at some point we'd formed a base. If you look at a higher time frame here, you have a bit of a base kind of case scenario. Now, a scalper might come in here and say, okay, well, I know that this currently has been a support zone. Interesting. We're clearly seeing some ramping of volume, and then something happens where it goes bang, kind of like it literally is loading up to get that position. Now, a lot of you will know this as a hammer candle or a spring or a rejection candle. And these often happen around these key points of liquidity. Now, if you break down that time frame, and I haven't done so, but we can do so together now. Let's go to a 2-minute chart and we scroll back over to in here. What you'll often see is very similar setups. So you'll have a market that kind of goes, in this case,
inverse head and shoulders.
Yeah, well, it comes in inverse head and shoulders. Well, that's a big candle, guys. But you also have this resistance here. It comes down and it takes that level. Now, that's off the back, remember, of setting up over here. So if you think about the sequencing kind of concept, it comes down, it goes up, it comes down, it breaks that, and then it pulls back aggressively, setting into that move. This is where people get uncomfortable. But actually, this is the positioning that a lot of scalpers and day traders, depending on, doesn't matter what time frame it is. Obviously, this is a 2-minute, but it could be a 1 minute, could be a 5-minute. That's the level that you really want to be focusing on.
Absolutely. And I think it highlights what we're really talking about, that, that's a 2-minute chart on the Euro USD. You've got a double bottom at the very bottom trough there. Then you've got the inverse head and shoulders that actually goes the big launch. But then you take that out and you're looking at a hammer candle or a pin candle. And probably it brings us to another point, and similar to what we've been talking about in naming things. Like, Tom said, he was right. Is it a pin? Is it a pin? Is it a hammer? It actually makes no difference what the damn thing's called, as long as you understand the price action. If you understand what is actually happening inside that candle, it makes no difference what you call it. So same deal, right? Understand price action, understand the movement. If the buyers and the sellers are having a war and the buyers win that war, the bigger the hammer or the pin, or call it whatever you like, the more convincing the buyers were, and that smaller time frame really showed that.
So Wyckoff often, because I want to just go back into Wyckoff for a second here, Ty, and we'll just jump off the screen for a second so everyone can see this. He theorized that the market was made up of what's called the composite man. So the composite man was effectively all the market participants together, kind of working in a unison to get a job done. And this is why so many people often fail as well in market trading. And again, this could happen on a 1-minute chart, a 30-second chart, a 1-second chart. It doesn't matter. It's a setup or a concept that a market hits a key level, and then it will effectively structure up in such a way that it will create all of these similar setups, and then it will move in the direction. And through this structure, it will often cause us, the traders, mental anguish if we don't know what we're looking for. So we have in this case what we call the BC, which is the buyer's climax, effectively the AR, automatic rally, and most importantly, these two here, the UT and the UTAD. Now, in this Wyckoff theory distribution schematic, the key here is really understanding that when the market goes above this resistance line, it triggers buyers. Okay, it triggers buyers. And those buyers are committed to the breakout. The market then pulls back, and then it goes back up and it does a new high, and then it reverses and breaks underneath. By doing this, it induces what we call liquidity, or it induces our orders from buyout-based structure and all sorts of things. And he said that if you see this type of strategy or you see this schematic, effectively that the market was getting ready, it was distributing and selling positions into you. And it makes a lot of sense. When you think about it, if you have $1 trillion of orders, you can't just press market sell, can you, Ty? That's not the way it works. It's not really possible. So you have to therefore sell them off over time. And the market will represent this in price action. And that's why it's such an interesting concept. And of course, it might not be necessarily the exact apex of scalping per se, but what it does do is it gives you a really good idea of the structure, and then you can scalp around that structure once you start to see it occur. So it's a really big thing. Got some questions coming in here about what about economic calendars? How does the 15-minute time frame get affected? Well, of course, scalpers will be affected heavily by something like economic news. In fact, economic news is one of the main reasons you get these types of false breakouts. However, because liquidity is provided and it goes through. But at the same time, it's not really, you just want to stay away from those types of events.
Yeah. The smaller the time frame, the more it's going to be affected by the economic calendar, really. And that's because you're getting a very hard and fast effect. That's right. So if you're trading, 2 and 3 pip scalps, if you like, you are going to be affected very, very dramatically by economic calendar, even if the news is not that big. Whereas if you're trading, the more bigger time frame sort of trades where you're in for hour, 4-hour, daily charts, economic calendars, they're still important, but not anywhere near as important as, I've really got to watch my stop loss here. I could get blown out. You got to be very, very careful around economic news on a small time frame.
So we'll just quickly go through the 3 laws of Wyckoff. The first one was law of supply and demand. Pretty obvious. Demand is over supply, price rises. Demand is less than supply, price drops. And if demand equals supply, that is basically there's an equilibrium in the market, no significant price change and volatility lowers. Can anyone guess here in the chat what kind of candle formation could be demand equals supply? Can anyone guess?
Doji.
Hey, whoa. we can't be telling everybody what is this? The Tyrone's in the chat right now.
I was excited. I got it right. I got yes.
No. Well, anyone that answered Doji in their mind, yes, the Doji. So of course, if you had demand and supply equaling each other, then you would obviously see something like this. So that can show you effectively an equilibrium in the market. A lot of people call it indecision. You can call it indecision, but it's basically equilibrium. It's kind of like the market saying, oh, I kind of like this price. It doesn't necessarily mean, remember, that there is a low amount of volume in that candle. It just means that the equal amount of demand and supply, that is buyers and sellers, were present within this range. So it can be something good to actually have a look down below at the volume at the same time. The next law was the law of cause and effect, Ty. This is another big one here. And it's Wyckoff's second law states that the difference between supply and demand are not random, and instead they come after periods of market preparation. This is really important. Remember, we're talking about that concept before of the schematic. Effectively, the way price can be formed in the market at key critical levels. Preparation is the key. If Wyckoff's terms a period of accumulation, cause, which can lead to an uptrend movement, effect, or vice versa with distribution. So you could have a market coming down, structuring up, breaking through, very similar to the schematic as we talked about before. And then all of a sudden you get that pullback and you're interested in that. And guess what you could see there? Similar to what we showed in the Euro before, that type of bullish pin bar or spring style candles, showing that there's a lot of buyers or demand in that level. So these were some really interesting points that I guess came out of Wyckoff's. And obviously he also had the composite man theory. But the big key really to understanding it all is to be able to say, okay, I'm going to use 3 to 5 separate reasons to place my trades. If I'm scalping, I want more than one separate reason, don't I, Ty? You can't just say one system is the best of them all. You need a few. I think he might have dropped, guys, but don't worry, I'm still here. So anyway, look, I'd like to hand it over to a few questions. In today's session so far, what we've done is we've talked about the idea that price will hit key higher timeframes. And in terms of the questions that we've had so far, I would say daily, 4 hour, 2 hour into something like a 1 hour are often the best kind of setups. That is, we would go from the daily and recognize the key levels and the weekly. We would then go down into something like the 4 hour charts and recognize them. We'd then go down into the 2 hour charts, down into the 1 hour charts, just make sure they were the same key levels. And then we'd, of course, dial in on that 5 minute, 15 minute. And once we've defined the levels, whether it's even 2 key levels coming into a session open, we could then look for that beginning of the structure. And the biggest thing is having that patience to wait for the market to show the activation, and then for you to be able to then react to that and, of course, wait for that pullback. And I think that's a big game changer, at least I felt it was, when it comes to scalping, day trading kind of techniques and combos. Multi-time frame analysis. We've talked about it for years, as I mentioned. It's because it works and it's a really great way of being. If you have any other questions, please feel free to ask them right now. Lazbel says, what material would you recommend to learn a bit more about Wyckoff? I'd probably recommend our course coming out soon, which will be based on that. And of course, some of the things we talked about here today. Otherwise, you can just search Wyckoff schematic and it will come up with some basic information about it. The thing about Wyckoff, though, is you really need to use it, have used it, and understand that it's an older concept that still works and applies in this market, and the footprints are still there, but it needs some, that's called jingle jangling. Ty, have we got you back?
Yes.
Oh, welcome back. Yeah. These are all trend systems. Look, again, it's what I would call scalping and day trading. To implement on top of that, you would then throw in things like the indicators. So you would go to, of course, something like a Bollinger, and you would add the Bollinger on top of it. You would then add something like a stochastic on top of it, and you just dial in on these timeframes. Again, it's not a trend-based system. If you find a key level, you could be going completely against the daily trend. It's just finding the key levels and then activating them on the small timeframes. So I'd probably disagree with you that it's a trend-based system. It's not. It's purely based on finding a key level of interest that you know there's going to be a fight between the bulls and the bears effectively. And then you recognize, remember that first quote we had, which was who has the greatest pulling power. Once you recognize that greatest pulling power, you can get that trade in to ideally find that 4-to-1, 5-to-1, 10-to-1 style ratio.
Yep. Paul says he found us by accident 20 minutes ago. Well, that's a good accident to have, Paul. Yes, mate, we do these very regularly. Pepperstone do these webinars every fortnight generally, with us hosting different topics. So this is tonight was one, obviously, advanced scalping, but we do different topics every fortnight. But we run live webinars effectively twice a day, every day as part of our community as well. So yeah, look at fxevolution.com and you'll see all the details there. So now we certainly do a lot of webinars, don't we, Tom?
Yeah, we do. Look, Pete's got another point as well, and he says you could always use the trading view replay function. So I've obviously just gone into that there. Yeah, of course. If you want to put more time in front of the charts, remember, forward testing is probably the best way of testing. Back testing is always a concept, but you'll never be 100% true to the real feeling. It's kind of like where the demo falls down. Demos are a little bit different to a live. I might as well ask everyone out there, did you feel a little bit different when you went from a demo to a live, or was it the same? Let us know in the chat. But in general, yes, you can replay, and then of course you can play that out and say, okay, what's happening next? Let me guess this. Let me look at this level. Let me structure it up. It's a good way of putting in effective time. The key to being a scalper or a day trader or any of these things is how much time are you going to be able to put in front of the charts. And a scalper or a day trader, even with this method, you're going to need to put in a little bit of time. I would say 1 to 2 hours potentially a day. Now, the good thing is with a method where you use higher timeframes to correctly find the key zones, you can set alerts for those key zones. And guess what? Some days they're not going to hit. What's that good? It's like a day off. Yeah, you're not going to get a trade, but at the same time, you don't put yourself in harm. It's the trades that you sometimes don't take that are the best ones.
Yeah. Choosing not to trade the wrong market is a trading strategy in itself, we always say.
Yeah, that's correct. So yeah, absolutely. You can do replay functions. You can do all sorts of things to kind of increase and speed up your process, but adding on 3 to 4 or even 3 to 5 reasons that are separate from each other based on and around price action, supply and demand kind of principles, support, resistance, that type of stuff, and market structure can be one of the big keys that we believe is a big game changer to day trading, scalping, or really any types of trading in general, whether you want to be swing or something else.
Most definitely.
All right. Well, I guess that probably brings us to a bit of a wrap up, Ty. We've got answered quite a lot of questions throughout here.
Yeah, thank you so much for your questions, guys. We've really enjoyed answering. It's good to have great involvement. It looks like people are very interested in this type of trading as well. So we'll be sure to pass that on to Pepperstone and let people know. Never feel afraid to contact Pepperstone and let them know what you prefer us to bring you on a fortnightly basis, because we are about bringing you the topics that actually work the best for what you want to learn. Now, for those of you who live in Australia or live in Queensland in particular, we have our annual conference, the FX Evolution annual conference, on the 29th and 30th of October. It is going to be an absolutely amazing event. We've got some amazing speakers. We've got a lineup of very, very intelligent people, and we've got Chris Weston from Pepperstone. Our very own Chris Weston. We call him our very own. No one surpasses his knowledge in his area of expertise, which is the very high level views of currencies, bonds, yields, anything. Talking to Chris in person will amaze you, and a lot of people get that opportunity to be there. If you can get up there, definitely try. Go to our website, click on the conference button, because you'll it's going to be a great event. And yeah, we would love to actually meet you all in person. We had a great event in Cairns, and the one in Sanctuary Cove promises to be even bigger and better. So yeah, definitely check that out, especially if you do live in Queensland, where you just have to turn up pretty much.
All right. Well, thank you so much for joining us as always. We'll see you in a fortnight's time, and best of luck out there. If you want to watch this video again, it'll be live available on the Pepperstone website straight after we finish up here. We'll see you in 2 weeks. And as always, good luck in the markets. It's going to probably be a volatile time. Remember, guys, this Friday is non-farm payrolls. Yeah. 8:30 a.m. New York time, 1 hour before the US stock market open. It's usually a pretty volatile period. Often the first move, I'll say this, often the first move is the false move when it comes to non-farms. I love it. It goes like, or it goes the opposite way about 20 minutes later.
8:30 a.m. New York time is probably not the time to be trading a 30-second chart on Friday.
I don't know. 30 seconds sounds good to me. All right. Thanks so much, guys. We'll see you in 2 weeks. Bye for now.
Thanks, guys. See you later.